Today, we're going to look at a cash and carry trade. And essentially, it's an arbitrage strategy that is going to allow us to pocket in the price difference between a derivatives contract and the underlying of that derivatives contract. Now, I know that might already be a little bit too much jargon, but I'm going to make it insanely simple for you to understand. Let's take, for example, Bitcoin markets. If you look at the markets, you'll see the spot Bitcoin, which is the price at which it's trading now. Let's say in the case of this example, 50,000. If you look at the futures market, you will notice that they're tracking the price of Bitcoin, but there's always a little extra on top of the price. So the price is always a little bit higher. Now, you don't need to understand the intricacies of derivatives markets and so on, but you do need to understand why there's that premium and also how it's affected by the expiry of the future. I'll make it again a little bit more simple. If you look at a futures contract that is a year out, so the expiry of that future is a year out, you will see that the price difference relative to the current spot price is relatively big. If it's a bit closer, let's say just 6 months out, the premium will be a little bit smaller. If it's 3 months out, even smaller. If it's 1 month out, smaller. If it's 1 week out, very, very close to the current trading price of Bitcoin. Now, why is that? Essentially, a futures contract is a promise of delivery of the underlying at a certain point in the future. So basically, when you're buying a futures contract, you're guaranteeing that you're getting Bitcoin at a certain price at a certain point in the future. But you have to pay a little extra for that convenience. Now, there's a lot of reason why people buy and sell futures contract. Essentially, it's about capital efficiency and leverage. But the concept itself is very simple to grasp. You're paying a little premium for the convenience of that time component. So if you're taking delivery of Bitcoin in just a year's time, you're going to have to pay a little bit more extra, a little bit more premium. If you're taking it in a month's time, it might be a little bit smaller. Now, if you look at the chart here, you will understand how a cash and carry trade works. If you think about markets, you see that essentially you're buying the same thing, right? Both the spot price and the future price are following the same pattern, right? They're following the same thing. It's always Bitcoin. But there's an interesting dynamic that you'll notice if you understood why a futures contract is more expensive when it's further out and cheaper when it's closer out. Once you've engaged in that futures contract, you will notice that as time goes by, the price difference, the premium, starts to narrow. And that represents an opportunity for us because we know with a certain amount of certainty that the price difference between the spot price and the future price will go down. The premium will shrink over time. So here, how you would put a cash and carry trade on is you would buy spot, so you would buy Bitcoin at let's say 50,000, and then let's say it's a 3 months out dated future that's trading at 53,000. I'm totally making the numbers up. You never see that big of a difference on an actual exchange. You would buy 50,000, you would sell at 53,000. And so immediately you can see there's that 3,000 US dollar differential that you're kind of locking in. You've bought 50, you've sold 53. That 3,000 differential is going to be your profit. How do you actually take that profit? You just need patience. So you need to wait over time and see that after a month in, the price difference is a little bit tighter, it's a little bit smaller. Why? Because actually in that futures contract, instead of having 3 months, now there's only 2 months remaining. And then you wait a bit longer, and now 2 months have elapsed, and there's only 1 month left in that futures contract. And so the price difference is even tighter. And then maybe 2 months and 3 weeks in, so there's only 1 week left, the price difference is even smaller because there's really only 1 week left of time component in that futures contract. And then you wait until actual maturity, until actual expiry. And there the prices should be either extremely close to each other or precisely the same as each other. So the fact that we have certainty that the price difference is going to narrow gives us an indication that if we've bought at a certain price and sold at a certain price, we can lock in that profit over time as the time component kind of shrinks in that futures contract. Now, some people maybe struggle to grasp that because they see that on the chart the thing is moving, or they ask me, why do we need to wait in order to lock in that profit? Well, if you don't wait at all, if you've bought spot Bitcoin and sold the future, and then you unwind the trade right away, you actually made zero profit. You just get back to your initial point. You bought Bitcoin and then you sell it right away. Okay. You sold the future, you buy it back. Okay. Nothing has happened. But Let's take a crazy scenario. Let's say that the price of Bitcoin for the next 3 months is staying exactly the same. So you bought at 50, and after 3 months, it's still at 50. So there's really no change in that position. You can buy it here, sell it here, and there's been no difference. If you look at the futures contract, even if the price of Bitcoin has not changed, you will see that the price has gone down. What you've sold at 53,000 at expiry will be worth 50,000. And so you've pocketed that 3,000 differential over time, because after a month it was maybe just 52,000 and then 51,000 and then it ended up at 50,000. So basically, you're shorting something that is losing value, while the thing that stayed at 50,000 the whole time just stays exactly the same. Now, actually, the whole thing is like that scenario is totally unrealistic. Prices move all the time. But because it's a market neutral strategy, you don't care. Let me explain what that means. If you've bought Bitcoin here, if you look at the chart and the price goes up, you're gaining, you're making a profit. But simultaneously, what you've sold is generating a loss, right? You sold something that has gained in value, so you're losing. At the end of the day, those two end up canceling each other out. And it's the same whatever the price does. If the price goes down, the loss you had on your futures contract is a bit lessened. But here, the gain that you had on your Bitcoin spot leg is a bit lessened as well. And they end up canceling each other out. And then the price rallies and you're making a big profit on your spot position that you bought, but you're also making a big loss on that futures position that you sold. At the end of the day, you don't care. It just cancels each other out. And you'll see it. I've put another chart here where the price goes down. The concept stays exactly the same. So this is on a forex pair, Indian rupee versus US dollar. So it's a bit different, but conceptually it's exactly the same. You see the price difference, and then there's a lot of wiggling going on. It's going up and down, mainly down, but it doesn't matter. You don't care, because whatever profit you would make from the sell position is counterbalanced by the loss you're getting on your long position on the stuff you've bought. But what you see here is at the end, towards expiry, the prices end up meeting and then totally being exactly the same. And that's the profit you're making. Is that shrinking between the premium, between the price difference of those two contracts. Now, I'll close up by saying this. It's a very safe and very popular strategy, especially with large financial institutions. If you've got a lot of capital, even if there's a small difference between one contract and its underlying, you can actually still make a lot of money. And you also need a lot of patience. So you need to have a lot of time on your hands so that you can take that lock in that profit, and then actually realize it over time. And large financial institutions typically have it, and they love that certainty of knowing exactly what return they're getting for whatever time they're dedicating to that trade. Now, there are risks to take into account, and there's essentially three things that you should keep in mind. The first one is you need to feel comfortable and safe on the platform on which you're trading, because as it happens in cryptocurrency markets, sometimes platforms end up defaulting, or maybe there's some issue with the data or the price volatility, something goes wrong with your margin requirements. There's a lot of things that can happen on the platform that would go wrong. Another risk that rarely happens but conceptually could is a default on the counterparty, so the other side of that trade, to take into account. The other risk that is maybe more likely is a execution error. So maybe you're buying the spot Bitcoin, that's one leg of the trade, and by the time you want to sell the future, which is the other side of your trade, um, time has elapsed and prices have moved, and maybe the prices have eaten a little bit into your profit, or maybe they've canceled out your profit fully. So you need to be very efficient, quite fast, and quite knowledgeable in how you're trading derivatives to put that trade through. The other thing to take into account, of course, is there's an opportunity cost, which is while you're locked into that trade and you're waiting for maturity, you're waiting for time to go on and kind of generate that profit, you can't do anything else with the capital. So if you're comfortable with, okay, I know what my yield is going to be and I'll wait until expiry, that's great. If you wanted to be a bit more active and do stuff with your capital, that's going to be a bit more of an issue. I will close up by saying, of course, that nothing I say is investment advice. I'm not recommending that you do anything or even use that strategy. I'm not advising that you buy or sell anything, but at least I hope you've understood the concept of a cash and carry trade. If you have any questions, feel free to comment down below. And if you've enjoyed the video, please put a like. It helps a ton. Thank you.